Let's talk about passive income because that's a very popular term, especially on the internet nowadays. Now, I don't like to use the term passive income because, well, there's really no real true passive income where you don't have to do anything. That's why I like to call it cash flow, because even if you go out and you invest in, say, dividend paying stocks, yeah, you don't have to do anything after you buy it, but you want to make sure that the investment that you own, this company that you own, is still a good company. And even if it's an ETF or an index fund that's paying out dividends, you still want to continue to monitor it every quarter at least to see that, well, everything is good and there's nothing really majorly wrong. So while, yeah, it can be passive, that doesn't mean that it's completely passive. And this is where now I like to call it cash flow. And I want to dive a little bit deeper into this idea of cash flow investing. First thing that I want to say is, well, you don't get rich by investing for cash flow, unlike what a lot of people like to say on the internet. What you do is you grow your richness or you grow your wealth by investing for cash flow, because the way that it works is you're going to take money that you've earned and you invest this money. And we'll talk about how to do that. But you invest this money, and then this money that you invest is going to spit off some money. It's going to pay you with some cash flow. But in order to have more cash flow, you need more money to invest. So you don't get rich from the cash flow. You got to make the money first. That way you can invest the money and generate cash flow. This doesn't mean that you need to wait until you're rich to start investing for cash flow, but you got to have the money first. Yes, you can start investing with as little as $100 to start generating this cash flow. And that's a great way to start. Just keep stacking small amounts of money to keep generating the cash flow. But you have to be realistic with your goals as well, because unfortunately, a lot of people get into this idea of passive income or cash flow thinking, oh, I got $2,000. I can't wait to be rolling around in the dough, which unfortunately, it doesn't work like that. Now, if you want to generate this type of cash flow, there are 4 general ways that I want to talk about in this lesson. Number 1 is by cash investments. Number 2 is through stock market investments. Number 3 is through real estate investments. And number 4 is through business investments. And I want to let you know right now that this business investment one is the most difficult one to do, and I'll explain why. Starting with cash investments. If you go and you put your money into something like a high interest savings account or a certificate of deposit in the bank, CD in the bank, you're going to be able to generate some interest. Now, nobody becomes wealthy through this interest. This is not something that you're doing to build your wealth. This is something that you're doing to park your cash as you're waiting for a better investment, but at least you can generate some interest. So what does this mean? If you have some excess cash, well, instead of keeping it in a traditional savings account that's earning you next to nothing, at the very least, what you can do is consider moving some of that money into a high interest savings account. You want to make sure it's protected with insurance. In the United States, we have FDIC insurance. Or you can also consider moving some of that to a certificate of deposit. Now, personally, I'm not a fan of certificate of deposits, but if you know you're not going to need this money for a certain period of time, it's a place where you can park the money and earn some interest. I'm going to say this one more time. This is not a place where you're going to get rich or build wealth. This is a place where you park your money and earn some interest while it's waiting, because now you're getting a little bit of interest for doing nothing except just waiting for a better investment opportunity. The second place we can invest this money is into the stock market, dividend paying stocks. Now, we did already talk about stock market investing in the second part of this quest, but when we talk about dividend paying stocks, I want to kind of take a step back and talk about why do companies pay dividends in the first place? Because not all companies will pay a dividend. And the reason why is because in order for a company to pay a dividend, they have to have the money to pay a dividend. And that means if you are a startup company, you're not going to have the ability to pay a dividend because right now you're in the growth phase, which means you want to grow market share as fast as possible. You're not trying to give away your profits. You want to reinvest all your profits and maybe even some more than that through debt or outside investments. That way you can grow as big as possible, as fast as possible. So your smaller growth companies are not trying to pay out dividends. They're trying to grow. And when you're trying to grow, you don't want to just give away your profits. You want to reinvest those profits. So when a company is paying out a dividend, generally that means that this company is a little bit more established, a little bit more mature, and they have a big enough profit where now it doesn't make sense for them to keep investing all this money back into the company. They don't want to keep saving this money, and now they can just give some of this money away to their investors. One of the ways that they can give this money away to investors is by doing something called a stock buyback, which means they buy back the stock, which helps push the stock price higher. And the second thing that they can do is pay out a dividend. This is the cash flow, which means now they're just giving away this money to shareholders of this stock. Now, in order for you to get this dividend, you have to actually own the stock before something called the ex-dividend date. But now you're getting paid for just owning the right investments. And when you want to keep up with your investments, remember, you are investing in the company. You're investing in the asset, not just the dividend. Do not invest in companies just based solely on whatever yield they're paying out right now, because that yield can be deceiving. For example, let's assume that a company is trading for $100 a share and they pay out a $3 annual dividend. That's a 3% dividend. But now, let's assume that something bad happened and this company's price fell to $50 a share from $100 a share. The stock price was cut in half, and assuming they haven't changed their dividend yet, that means they're paying a $3 dividend on a $50 stock. Now that's a 6% dividend yield. Looks pretty attractive, right? But you're not looking at the whole asset. The stock price fell by 50%. Maybe there are some major issues with the company, and this is why you do not want to invest in stocks based solely on their dividend yield. You want to look at the asset first and then the dividend. And even if you're investing in ETFs or mutual funds or index funds that are paying out dividends, that's okay. There are funds that are specialized solely in paying out dividends. You still want to keep monitoring it to make sure that nothing's wrong with this fund or these assets that you're investing in. So just understand that yes, this can be a very passive way for you to invest to generate cash flow. However, you still want to keep up with your investments. The third way that you can invest for cash flow is in real estate. Again, I love investing in real estate, but it's not completely passive. You can make it more passive by hiring a property management company. Like I have multiple property management companies to manage my real estate. And it does make it more passive for me. Like I don't know who the tenants are in my properties. They don't know who I am. They don't have my phone number. When something goes wrong, they call my property manager. If it's small little minor things like most things are, I don't even hear about it. I get a monthly and a quarterly report talking about how much money each property made, talking about what our expenses look like, and talking about how much our net operating income is, and what other expenses we might have, and if we should reinvest money back into the properties. But that still takes some time. I'm looking at these reports every month. I'm looking at these reports every quarter. I'm meeting my property managers every so often. Again, I'm not working in the deal. I'm not working to lease out the properties. I'm not working to make sure the bills are paid. But my job is to make sure that the investments that I have are still producing cash flow, that these are still producing good returns. And this is where now, yes, it's cash flow, not completely passive, because even though I have a property manager, I still got to manage the property management company. But if you want to invest in real estate and you think, man, I don't have the money to go out and buy a full rental property, there are other ways for you to get started. In the stock market, you can get exposure to real estate indirectly by investing in something called a REIT, an REIT, which stands for Real Estate Investment Trusts. This gives you the opportunity to invest in a company that's investing in real estate. So you don't actually invest directly into the real estate. You're investing in a company that owns real estate. But the advantage with REITs is you can also generate some cash flow. Personally, I'm not a huge fan of REITs because I like owning the physical properties, but that's one way to get exposure to real estate. Another thing that you can do is consider investing in something like potentially syndicate real estate deals. Nowadays on the internet, these are often known as crowdfunded real estate deals. Now, what this means is somebody, an investor or a developer, wants to go out and they want to build this property, or they want to buy this property, they want to renovate a property, but they don't have all the money. And so they're going to go out and try to raise money from investors. And now you will essentially get either ownership or indirect ownership into a property or a portfolio of properties. You don't have to worry about trying to find a tenant. You don't have to worry about doing any of the work. You don't have to worry about trying to manage the property. You're giving your money to an investor who's going to manage and handle the entire deal. And now if this property generates a profit, whether it's from cash flow, or this investor can sell the property for a profit, or they can refinance your money out, now you can make your money from indirect exposure to real estate. Again, this is an alternative way for you to get exposure to real estate without going out and actually buying the entire property yourself. And this can give you the ability to start investing in real estate with a lot less money. Like I know on the internet, there are some funds that will let you start investing in real estate with under $1,000. So if you want to invest in real estate, you can buy the actual property. You can invest in crowdfunded deals. You can invest through the stock market to get exposure to real estate. But the key here is now you're trying to get exposure to the physical real estate asset. And the goal is to generate cash flow. But even though it's passive, it might not be completely passive, and you want to make sure you're still managing the manager, you're still managing the deal to still make sure that the cash flow is coming through the door. The fourth way that you can generate cash flow, which is the most difficult way to do it, is through business. And this could be through either you going out and buying a business or you creating a business. But in order for you to do this, that means you're not actively working in a business. Because let's go through a quick example. Let's assume that you go out and you create a guacamole company. You come up with a great guacamole recipe, and you can make $1 million a year in revenue from your guacamole business. Pretty good. Now you're going to have expenses. Let's say it costs $400,000 to run the business. That means paying your salaries, paying for the avocados, paying for the spices. And then you pay yourself a salary of $100,000. That means the business has a $500,000 profit. You're paying yourself a salary of $100,000 to be the CEO of the company, but that $500,000 profit goes to the owner of the company. You currently, if you started this company, are the owner and the CEO. So you're getting the salary, and then you have the rights to this $500,000. Now you can decide if you want to reinvest that money or take it out yourself, but you get to make that decision because you are the owner. But that also means that if you can scale this business to a point where you can fire yourself as a CEO and hire a new CEO, now you can bring somebody on, pay them that salary, the $100,000 a year. Maybe you give them a little bit of incentive or whatever to continue driving up the valuation and driving up the profits of this company. But those profits now are yours because you own the equity in the company. And so to build your company to this point, it takes a lot of time, takes a lot of effort, takes a lot of work, takes a lot of years, it takes a lot of risk. But it gives you the opportunity to generate cash flow if you could fire yourself as an employee in the company. The second way you can do it is you can go out and buy a business. But the key is not buying a business that you have to work in. You're essentially doing the same example that I just told you, but now you're going to buy the guacamole company and hire a different CEO, or maybe there's another acting CEO already working there. So now you're buying ownership or equity in the company, but you're not actually working inside of the company. Now, for you to buy a company that doesn't require you to work there, just practically speaking, is generally going to cost you at least on the low end a couple $1 million to get into these types of businesses, if not more. But again, this is why it can be one of the most lucrative, but also one of the most difficult ways to start entering this type of business cash flow. So if you want to start generating cash flow, there are 4 general accessible ways to do it. Well, 3 more accessible ways than the 4th. And that means now investing your money for cash, that's interest in a high interest savings account or a certificate of deposit. Again, this is not going to make you rich. This one's just there to park your money and generate some interest as you're waiting for a better investment opportunity. Number 2 is investing your money into stocks to generate the dividend income. These are profit distributions. Number 3 is investing your money into real estate directly or indirectly, that we can generate the cash flow. Or number 4 is so you can generate the profits from a business that you own. What I'd like you to do now at the end of this lesson is I want you to think about what are the 2 to 3 ways that you want to start generating cash flow in the next 24 months. What's accessible to you and how can you start doing it? And then I want you to post this in the community. That way you can hold yourself accountable and then go out and actually implement this.